Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, July 3rd. US equities advance to fresh highs on trade optimism, but the trade news are questionably good. Economic data is understandably soft, and long maturity yields in Western sovereign markets are coming under renewed stress. So what could go wrong? We will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the S&P 500 advanced to a fresh record high yesterday as Nike jumped another 4% yesterday and is up by 45% since the April dip on news that the US and Vietnam signed a trade deal. So when you see the price action, well, you might actually get confused and think whatever has been signed was good, right? But no, well, it wasn't really brilliant to say the least. Under this agreement between the US and Vietnam, the Vietnamese exports toward the US will be taxed at 20% at arrival, and goods that transit Vietnam to go to the US will be taxed at 40%. So we are talking about goods that could be coming from China, for example, and transiting through Vietnam to go to the US. So yes, Vietnamese goods will cost 20% more expensive moving forward than they did before the tariffs. So that's 10 percentage points above the 10% universal tariffs that were applied until now. And even though Vietnam could avoid a 40-something% tariffs as it was proposed on the initial Liberation Day, it will make whatever comes from Vietnam 20% more expensive in the United States. In exchange, well, the US goods will enter Vietnam without tariffs. Yeah, so it's a total power show. But Tom knew if it could make the US stocks hit a fresh record high yesterday and help mood improve at Nike, Lululemon, and Under Armour. They really needed some news, whatever it was. Maybe more optimistic, while the US reportedly lifted export license requirements for chip design software sales in China, which led Siemens to restore its Chinese customers full access to its software and its technology. So that actually comes a week after the US signed a trade truce with China. Remember, resuming the Chinese rare earth metal exports toward the US, which is so critical to the US companies. Now, other companies that have been hit by such export restrictions include Synopsys and Cadence Systems, and these companies should also see an improved appetite from investors in the coming days on these good news about the relaxed exports of chips and chip design materials. So the rest of the semiconductors could also get their hopes up, mind you, regarding their Chinese businesses, and I am looking at you, Nvidia. Even though Nvidia didn't wait the trade news to improve, nor AI appetite to lose momentum to reach out to new and as lucrative markets and life-changing technologies like robotics, which backs the company's stock price nears all-time high level today, with pretty strong analyst forecasts moving forward. The one on the CNN survey, for example, shows that out of 65 analysts, 89% have a buy rating on Nvidia, with the highest price target standing as high as $250 per share. 9% of them give a hold rating and only 2% recommend to sell at the current prices. With a P ratio below 50, I actually think that Nvidia should keep its status as the king of AI among major AI stocks as industries transition to AI and those who do not think of doing so. Microsoft, for example, is clearly on its course to slash 9,000 more jobs that will be replaced by AI, and Salesforce CEO recently announced that AI is now performing 30 to 50% of the company's internal work, and this is the future, guys. So you get a hint of where things are going right now. So yes, AI remains a hot theme of the moment, and it is not just speculation, and Nvidia's PE ratio that's near 49 today is a proof that they're not just rallying on speculation. Elsewhere, the news are much less brilliant, mind you. The US ADP report that was released yesterday printed a negative number. warning that the US economy lost jobs in June instead of adding jobs. So that's obviously bad news per se, and the market's first reaction to the negative ADP report was a sell-off, but then the trade news just came in and investors simply forgot about the weak ADP data and just rally. Now note that yesterday's negative ADP figure somehow increased the probability of a July rate cut from the Federal Reserve from around 21 to 22% to above 27%, but the US 2-year yield that best captures the Fed rate expectations didn't even ease. On the contrary, the 2-year yield rebounded past the 3.80% mark yesterday and is consolidating just a touch below this level this morning at the time I am talking here. So today, the US will be revealing its latest official jobs data. So it's going to be a day earlier than usual because the US will be closed due to July 4th holiday on Friday. And well, a consensus of analyst estimates on Bloomberg expect the US economy to have added 111,000 new non-farm jobs in June, with a slightly slower growth in average earnings on a monthly basis and a deterioration in the unemployment rate from 4.2 to 4.3%. Now the thinking goes, a set of softer than expected NFP data from the US today should further boost the Fed dose and help the S&P 500 maybe stay near all-time high levels unless the data is really looking bad, while strong data could again be confusing, as it has been the case in many occasions earlier this year, and back the Fed's view that the labor market in the US remains quite resilient despite all the trade chaos. But whatever the labor data, remember that inflation in the US will let the Fed or not let it cut the interest rates later this year, because if inflation in the US hits up due to tariffs, and it probably will in the coming months, the Fed may have to turn a blind eye on the deteriorating jobs data. It is only when the job and growth metrics in the US will start flashing red that the Fed will be brought to act despite expectations of rising inflation. And if that's the case, we should at least see a remarkable downside correction across equity valuations to lead to a meaningful dovish shift in Fed's policy. So in summary, I do not think still that soft jobs data from the US this week will justify a rate cut in July from the Fed, even less so as US crude managed to hold ground below the critical $65 per barrel level and is now consolidating its latest advance within the medium-term bullish consolidation zone. On the other hand, keep a close eye on long maturity yields across Western sovereign markets because they start giving signs of stress, and that's never good, especially when it comes in the summer months. The trigger for that was a British drama yesterday after Keir Starmer failed to confirm immediately when asked yesterday whether the UK Chancellor Rachel Reeves will be staying in her position, while Rachel Reeves was wiping away her tears on the bank behind him. So the picture, the imagery painted there told loads about the UK's narrowing fiscal headroom, the necessity to reduce spending, which is not great for growth, raise taxes, and convince the bond investors that gilts are still investable. So the UK 10-year gilt yield jumped as much as 25 basis points yesterday, pushing the US 10-year yield shortly to 4.30% level as well, and the Japanese 10-year yield is reversing the latest decline right now. So today we have in hand 1, trade deals that are pointing at meaningful tariffs even after the negotiations. 2, weakening economic data from the US but rising inflation expectations. And 3, renewed stress in long-term sovereign markets. So it's quite a sour cocktail. Be careful. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.